First, good morning all. It is a real pleasure to be with you in Prague personally after such a long period of time. First, allow me to thanks and congratulate to the Czech Insurance Association and with Insurance Europe team that they organize such a inclusive and amazing event. Now, I think after this inspiring introduction, we have to start to deep dive on the topics that were well introduced. I will be helped by two outstanding speakers. The first is, on my left, is Jérôme Jean Haegeli, who is the Group Chief Economist at Swiss Re Institute. And the second is Alan Sheppard, who is a Senior Technical Advisor of the UK Prudential Regulation. The two speakers that are one from the private sector and the second for the public in a broad sense, I think gives evidence how the the protection gap that we have to go through, find a solution to reduce, because for sure we are not able to eliminate, but our target is to find a way to reduce it. And I think from my point of view, one of the main elements you have to combine different stakeholders, because as industry, for sure, we have to be profitable. This is, I would say, a necessary condition to be sustainable in doing this exercise. Second, I think it's a long journey. Nothing will come shortly. And for this reason, I think we have to be committed, but at the same time, long-term targets are difficult to reach because we have not a way to monitor the journey to be there. For this reason, we have to have intermediate steps to monitor where we are. Now I jump in the discussion, and I have a first question to Jérôme. Why are the protection gaps so important, and why do you think about them?
Well, thanks very much, Sandro. And it's great to be in panel with you and with Alan, and it's great to be here also in Prague. And thanks to the President of Insurance Europe and also Secretary General of the IDF, really inspiring speeches. And closing the protection gap, why do we need to do that? I think it's so obvious. We have just been coming out of a systemic crisis, which is COVID-19. And COVID-19, it is not a black swan event. And if you add everything up, COVID-19 and now also the war in Ukraine, but before that, European debt crisis, and before that, the global financial crisis, and before that, the Asian crisis. Over the last 10 years, we had a number of key financial market and economic crisis, systemic in nature. And we don't have the protection now coming out of COVID-19. We're just barely recovering of COVID-19. Fact is, if I look at the economic landscape, this is the hurricane number 5, with a strength of number 5. It happens every 30 years. Every 30 years in the US, you have a hurricane 5 hitting land in the US. If you look at the inflation, it's the cost of living crisis. If you look at recession fears, if you look at COVID-19 and maybe potential new variants of COVID-19, on top of that, if you look at geopolitical dimensions, the multipolar world, which will also increase inflationary pressures and will also mean there's going to be reconfiguration of globalization. And we are seeing now monetary policymakers rightly retreating from their from their super activism before. They needed to retreat. It would have been better if they would have retreated earlier, but now they're retreating, and also we are coming out of COVID-19 with, let's face it, and let's be clear, with a debt hangover, and we cannot afford to spend like there is no day tomorrow. And this is why I really truly believe keeping focus on where are these protection gaps, how can we tackle the protection gaps, and being in the dialogue with the public policymakers is so all important. And here we as an insurance player have a key role to play in analyzing the situation, making the bigger picture, giving the data. If I think about data was mentioned before, we at Swiss Re, we put into place and engineered the concept of resilience indices. We look at resilience indices for each insurance peril every year and do that since 2019. We do the same on the macro front, and we engage with that with the policymakers so that they can see a way to bring in into households, but also into how to think about public balance sheets, the form of insurance. It's the first form of insurance is always self-insurance, precautionary savings, but that's very inferior, and that's why having insurance, public-private insurance schemes is so important. But first of all, having the analytics, having the right data, and also discourse with public policymakers is so important, and it's so important coming out now of all these crises, because it was said before, I totally agree, the world now, it's a totally different world than it was 6 months ago. Again, it's a totally different world than 2 years ago. It's not going to be a stronger world, it's going to be a world with lower growth, and it's a world where the monetary policymakers, rightly so, has to fight inflation. So the figures that we heard before from the Insurance Europe president, fact is 75% of Notcut events are not protected. Fact is, according to our research, and now we will close, fact is on our research, the protection gap in terms of premium equivalent terms is more than $1.3 trillion. And that's the last figure from last year. By the end of July, we're going to come out with the new figures, and you will not see a surprise to see another increase of these protection gap figures amongst the key 3 perils, which is Notcut, mortality, as well as health. And all inflation, the cost of living crisis, just increases the protection gap that we all are interested to close. Probably we will not be able to close it, but at least narrow it. And by the way, I also look very much forward on that sense, and we put out a Sigma report in terms of narrowing protection gaps. It's also looking at income inequality, because that's also a driver of protection gaps. And I see the panel afterwards is also going to discuss about ways to close the protection gap, and looking forward to see that discussion as well. But let me close for now. Thank you.
Thank you, Jérôme. Now a question for Alan. No? What drives them, and why are they staying for so long? This, I think, it's another question for you.
Thank you. And first, let me say what a pleasure it is to be here in person, and I'm very grateful to Insurance Europe for the invitation, and of course to our Czech hosts for putting on this event. Really good question, Sandro, about the drivers. Clearly, we need to understand the underlying economic drivers of protection gaps if we're going to be able to come up with good solutions. There isn't a bright line, but I would make a distinction between developed and emerging economies here. I think the problems are somewhat different, and certainly the emphasis we need to place on different drivers is different. So starting with developed economies, I mean, notwithstanding some of the remarks earlier about the existing protection gaps in developed economies, I think the major challenge here is the risk of widening and the emergence of new protection gaps because of a number of factors. First and foremost, growing systemic risk from a number of sources, and growing realization, I think, amongst the industry of inadvertent exposure to systemic risk, by which I mean global undiversifiable underwriting risks. And that's clearly emerging in areas like climate change, but also cyber has been spoken about extensively already this morning, and of course, pandemic. As our previous speaker pointed out, we should not expect that we are through the current pandemic, or indeed that this is the last that we will face. The second driver I would highlight is the era of uncertainty that we live in, as well as the challenges we've just spoken about. Geopolitical uncertainty has been mentioned by most speakers as well as being a very present challenge. And that, in that era of uncertainty, an insurance industry which has modeling intrinsically at its heart and which relies heavily on data to drive that modeling, is clearly challenged in its ability to efficiently price risks. And some speakers have mentioned the need, have talked a lot about the need to fill those data gaps as a route to more efficient and effective pricing and therefore greater insurability of key risks. That's one important aspect. I think another aspect is learning to price in the absence of data or with sparse data. And I think regulators have a role to play there in not putting barriers in the way of more innovative risk management and pricing techniques which compensate for inadequate data. And then the third area I'd highlight in developed economies is perhaps a more mundane one, but existing well-known risks where there's a big social benefit from the existence of insurance cover. And I'm thinking of things like various forms of indemnity, which are essential to allow economic projects to go ahead, but risks which are unattractive to insurers because of uncertainty or because of an unattractive risk return. So just a couple of examples to give there. One would be directors and officers cover, where we've seen very large volatility in the pricing of that cover, and I think that's driven by emerging fear of social inflation, uncertainty therefore about the expected losses, but also perhaps a fear of uncertain impact of climate litigation, which hitherto has tended to have the goal of forcing cessation of harmful activity rather than extraction of financial compensation, but I don't think we can take for granted that that would remain the case, or that the two goals might not become linked. And I'll come back to say a bit more about that if there's time to talk about the findings of our climate stress test announced last week. Turning briefly to emerging economies, here I think it is not so much the risk of a protection gap, but a very clear and large existing gap that holds back investment and development in emerging economies. And I think the problem is essentially one of asymmetry of information, absence of data, absence of modeling infrastructure and risk management infrastructure that allows insurers to price risks with confidence, but also a more general need for development of financial infrastructure. Individuals and corporates in emerging economies often have low purchasing power and very severe credit constraints, which makes it difficult for them to purchase even efficiently priced insurance. So in summary, in emerging economies, a general weakness in financial infrastructure that needs to be addressed.
Thanks, Alan. Now I move to Jérôme again for asking a question that we are used to refer to the Notcut risk, and the main question, if due to the climate change, if it is insurable in the future at a reasonable price. No? I think I want to focus on this, but I would like to enlarge the discussion on affordable price, because the same concept applies to cyber, I would say, and in a broad sense apply to the pension gap, because the power of compounding interest rate makes clear that how much people pay to have a pension product is important. How do you think this, the issue of pricing, because I think my first point was that we have to be profitable, because I think, especially due to the fact that we have to maintain our promises, and the only way to be to fulfill these promises is to to be solid in terms of profitability. How we will deal with these topics, because this is an important trigger to reduce the different type of gap that we have in the market.
Well, thanks for asking, Sandro. So on the question of what about the pricing and capacity of the industry to absorb Notcut risks? 75% is not absorbed, so the amounts are all going to increase, no question about that. It's inflation, it's the accumulation of risk. But do we have the capacity as an industry to absorb Notcut, especially given the climate change? I think there the answer clearly is yes, we do. We do have the capacity when you think about the capital strength of the insurance industry. Second, we do have the capacity when you think about modeling, and I don't just say it because it sounds nice, but because it's true. And here I focus on flood risk. Flood risk is, I think, one example. It's a secondary peril which has become primary in sense of severity and frequency, flood risk, natural catastrophe front. If you look at modeling capacity on the flood risk, it's much different today than it was 10 years ago. And there the reinsurance industry, with the better modeling capacity, can also provide much more granular risk determination and pricing metrics that are never before. So it remains insurable. That's the good news. Obviously, the price is a function of severity and frequency. And climate change doesn't make it easier, it worsens it. However, let's be clear, it's not just climate change which impacts frequency and severity, it's also the accumulation of wealth, it's urbanization, it's where you build, where the accumulation of wealth is in Asia, along the coastlines, in advanced economies. And if you look at our research, we can definitely say that climate change is increasing to the severity of natural catastrophes, while for secondary perils it's also definitely climate change as well. But yeah, I think the good news is it remains insurable, and we have all interest that the pricing remains affordable. And I think there it also is key, and it's clear that we're all in the same boat, and we all have interest to make sure that we take care of the planet and that we reach the net zero agreement, net zero economy goals by 2050. If I look at where we are today in terms of net zero progress, I'm definitely disappointed if I look at the policymakers' pledges and what is needed in terms of actions. We are falling behind. Much more needs to be done. So pricing likely will be going north, right? As climate change still continues to accelerate, and as the Paris Agreement seems to be further away than actually closer. But at least we are all aware of where more action is needed, and we need to take care of climate actions as we have been taking care of COVID-19. It's systemic. We need to deal it today. However, I think taking care of climate change is much more complex than COVID-19 because of this time consistency. That's why I think we also need to work all together with the public policymakers in terms of getting the data out, making sure that there's transparency, making sure you have the regulatory capital framework in place, incentivizing green investments or green infrastructure investments as an example, but also having stress tests out there which make sense and which are comparable across industry. I know I talked a lot, but I think the issue of pricing and capital, it's very much dependent on also how climate change evolves, and no question about that. Private and public sector need to work together so that the pricing remains affordable, but the industry has done a lot in terms of capabilities of pricing risk, and no question about, yes, it remains insurable as a risk, at least of today. Affordability in today's cost of living crisis definitely is a different question. Thank you.
Thanks, Jérôme. A question for you, Alan. I think there is a growing concern about inequality and pension gap and pension, the protection gap in a broad sense is another dimension of inequality between classes and between regions. What is your view and how we could, I think, reduce this topic?
Thank you. I mean, certainly for me, closing those existing protection gaps in emerging economies should be the priority for the industry for a number of reasons. First, as has been pointed out by several speakers already, this is an actual gap, existing gap, not the risk of one, and it is suppressing investment and development in emerging economies. Secondly, we can expect demand for insurance in emerging economies to continue to rise rapidly, hand in hand with the more rapid pace of economic growth in those countries. And third, as again has already been touched on, because these are economies which are going to be the most severely affected by the effects of climate change and the uncertainty developed. So a big problem, and a problem which is likely to grow and grow rapidly, and therefore a priority. Is a closing of that gap achievable? I think so, yes. I would highlight again the kind of work undertaken by the Insurance Development Forum, which we heard a lot about from the previous speaker. The forum indeed was a founding member of that forum was the previous governor of the Bank of England, Mark Carney, and the PRA has consistently supported the forum by contributing its own technical expertise to the modelling challenges that the emerging economies protection gap throws up. I'm optimistic because I do think the necessary expertise in risk management and pricing already exists. It's just not reaching the places it needs to at the moment. But it should be. This should be an actual opportunity for existing established wholesale insurance hubs like the London market for a couple of reasons. First, as I already said, that the relevant expertise exists there in the private and the public sector. This modelling challenge that we face, it is very similar to a cat risk modelling. It is extrapolation into the tail from a limited data set. But secondly, because I think there's a lot of scope in wholesale insurance centres to add more emerging economy risk, which at the current low levels that it exists would diversify very, very well against more established cat risks in developed economies. The role of regulators, as I touched on already, I think is as much to avoid erecting barriers to solutions to the problem of sparse data as anything else. I might come back to that later if there's time and say a little more about how we're tackling that in our own review of insurance regulation in the UK.
Thanks. I think the time is running fast. For this reason, I would open the floor to some question, one or two questions from you, if you have any, before moving to the close of the... Please. Yes.
So yeah, my name is Julien Bédouche. I'm working for Lloyd's Europe. And my question is, I was wondering if you think that the characteristics, the features of the protection gap are the same for the retail market and for the corporate market? And if not, do you think it's more an issue for one or the other? Is it more an issue for the retail market, or is it more an issue for the corporate market? Thank you.
Happy to take the first answer. Question was, is protection gap more related, or is it more a market for retail or corporate market, right? And I think it depends which jurisdiction you look at. If you look at developing countries, then obviously the market is actually a public market. You work with public authorities in terms of giving and driving parametric solutions for Notcut protections. And there we work with the sovereign so that they have protection when a natural catastrophe hits the land and the factories or the buildings, that doesn't become a fiscal distress event. And obviously, if I think about IDF, this is also a place we work and partner a lot. So there, I think it's very much the public partnership side. However, if I think about other areas, be it pension gaps, and we alluded a little bit pension gaps, I think that's at the end of the day, even in advanced market, it's something where we need to engage, and we do engage with public policymakers, because not in all countries do we have the pillar system which really works and really serves the purposes, especially in today's of demographic challenges. Then if I think about the other perils, health, with health and mortality, and actually the healthcare related protection gap is the largest one in our view. It's out of the pocket expenses which leads households to become distressed. The end user obviously is retail, right? It's household, but often it's often, I think, from my end, it's often work needed to work alongside with the public policymakers so that we can design products that are affordable, that are maybe tax incentivized or subsidized, so that households can take it on, and so that you have a protection for the more vulnerable ones. So I think probably you can't really separate the end consumer is households is us, but the conduit therefore is often needs to entail the public policymaker or the state. Thank you. I don't know if you see it differently.
No, not at all. I mean, I just very quickly add a couple of thoughts. I think for economic growth and development in emerging economies, probably the protection gap for corporates is the more important, but equally clearly for improving quality of life. The retail protection gap is one that's essential to fill. Again, the role of regulators here, I think, is to be even-handed. There's some perception, and I did speak about this a few weeks ago, there is some perception that the regulator can be heavy-handed in the wholesale and corporate sphere and not take proper account of the sophistication of the policyholder, the great sophistication of the policyholder in the large corporate markets. Very much not what we aspire to do. We do aspire to a principle of proportionality, where we achieve the same standard of protection for policyholders from the smallest retail to the largest corporate, but in the way we achieve that, we take full account of other forms of discipline, and clearly there is a great deal more market discipline at the large wholesale end of the market, and individual policyholders are able to effectively monitor and assess their insurers in a way that retail aren't. So the goal for regulation and supervision is to achieve the same standards, but through different routes, and therefore not to generate any kind of relative mispricing between retail and corporate. Thank you.
I am sorry, but the time is running out, and I think I will do the final question, also collecting some of the questions that arrive through the tab to each of you. Two simple questions. Could you share any insight related to the solution provided by the insurance sector to close the gap? And how do you think the collaboration between public and private could be a way to address this type of risk and any systemic risk? Just to join in a very few minutes.
Yeah. Sure. I'll start on this one. I'd like to talk a little bit about the role of government and public-private partnerships in closing protection gaps. I must emphasize at the start that any decisions in this area clearly have important fiscal consequences for government, and therefore such decisions are very much for government and not for prudential regulators like myself. That said, I can offer a few thoughts. I think we all understand that governments are implicit insurers of last resort, And that fundamentally is thanks to their taxation powers. The ability to tax now and in the future gives government this unique ability to spread losses across the whole population via current taxation, or indeed across generations via long-term borrowing and future taxation. And from this derives this implicit role of insurer of last resort for those systemic risks. But there are perils to leaving this role implicit. The first is a form of moral hazard, where economic agents may take excessive risk because they're relying on an implicit safety net from governments, but an unpriced one. And this allows unsustainable activities like, for example, building housing on floodplains to go ahead without any kind of market discipline on it. But the flip side is the risk of protection gap, lower investment because of potential exposure to systemic risk, which limits availability of insurance, but also means without that explicit protection, either from the private sector or the public, economic projects that would drive economic growth become unattractive. By the same token, though, if to solve these problems, governments do step in to make their last resort role explicit, for example, by guaranteeing loss-sharing vehicles such as Flood Re that we have in the UK, it becomes even more important that the risk taken on by government is properly measured, so the fiscal impact is understood and can be properly controlled. And second, that the risk sharing provided is properly priced to avoid subsidizing unsustainable activity. That doesn't mean it always needs to be fully priced, but governments do need to understand the price of the guarantees that they're writing and make an explicit policy decision whether to pass that on or whether to effectively subsidize as another tool of public policy and put necessary safeguards in place to substitute for that pricing discipline.
Hey, thanks very much.
There's Swiss, 1 minute.
1 minute, and I will use 60 seconds. Sounds better. Well, I will just compliment on what my colleague just said. Product and process innovation is super important. The insurance industry, what they do on the advanced data analytics front. Blockchain will change it as well and accelerate that. Microinsurance is all about affordability. There we look forward also what the next panel has to say. And we also have a call for action in our Sigma in terms of income inequality and also need to strengthen social security. And then let me just conclude. I think all about developing new distribution channels is going to be important. We saw with COVID-19 digital insurance channels having become more important. I think that's good news. And then last point, yes, obviously, governments and the private sector, we are all in together. And if I look at some Asian countries, but also especially China, I think they are more advanced than in many other parts of the Western world. But it's up to us, right, to provide the analytics, the risk management capacities, the data, and then also do the educational part. And that's why I think events like this, Insurance Europe, putting the topic on the center stage is so helpful and so important. So thank you very much, and giving back to Sandro.
Thanks a lot to all of you. Now enjoy the coffee break. Just